Hello, everyone. Pat Smita here with Peachy Lending for your Wednesday, February the 26th interest rate update. We did get new home sales today, and we did see a decline month over month and year over year. The month over month number was a little bit more pronounced because we did get some adjustments from last month that made it even look worse based upon what actually happened in December. But higher rates are starting to eat into volume, which means that essentially we are going to see lower numbers and potentially lower appreciation. We're still looking really good, so don't get me wrong. But at the same time, this is a bit of a pause, which could lead to lower purchase prices. Now, the median sales price is 446,000, which is really great, and the signed contracts were about 657,000. Now, at the same time, after the market closed, we did get the following news from CNBC that the Federal Reserve's favorite recession indicator is flashing a danger sign. This means that the interest rate paid on 10-year debt is lower than the interest rate on 3-month debt. And that's very important because you would think about it that if you loan somebody money for a longer period of time, you get a better interest rate. Instead, the opposite is happening, where people are worried that short term there may be an economic slowdown. So they're asking for a higher rate of return than long term, where they think everything's going to be okay. So please keep this in mind, because what this can actually help bring down interest rates even lower if market sentiment decides that we are really going into a slowdown. Intraday, we did have some really nice growth in mortgage-backed securities. Remember, when the value of a mortgage-backed security goes higher, interest rates fall. And as you can see right here, we did get a nice growth. It did flatten out toward the end of the day because tomorrow we do get a lot of news, plus NVIDIA reported earnings, and they were really good. At the same time, if you look at overall market pricing, we have had a very nice run up over the last 9 to 10 days. However, we are reaching some key levels here. Remember, market does have memory, so it's going to remember some pivot points that are going to act as stop levels, whether high or low. Here we have one that we're coming up that we just reached, and then we fell back down. So if we get more deflationary news or the economy slowing down, we could break through to these levels and really get better interest rates overall over the next couple of days. However, the reverse could happen as well. If we get inflationary news, we could see interest rates rise again with the mortgage-backed securities falling. Now, tomorrow, on Thursday, February the 27th, we do get 3 key pieces of information. We get the initial and continuing jobless claims. We do get gross domestic product annualized. This is very important. GDP is the way we measure growth in the U.S. economy. And a weak number could mean that, hey, we are seeing a slowdown in the economy. We could see more people running from stocks and buying safety assets like 10-year bonds, which means that they could bring interest rates even lower. Finally, we get durable goods orders. Now, these are goods that are meant to last over 5 years, that are your washing machines, your cars, your airplanes, really high-ticket items. If we see weakness in that, that'll be another affirmation that, hey, we are slowing down as an economy, and that interest rates will be coming lower, and the Fed is going to have to act to lower interest rates. So please keep in mind, please keep an eye out for our posts to see what's going on, and we look forward to speaking with you. If you have any questions or would like to price out any deals, we have some awesome rates happening, so please give us a call.